Good morning, everyone. Welcome to Business Summit. It is a great privilege to have you again with us today. We will be starting our summit in the next 2 minutes, but meanwhile, it is good to see everyone. I can see Mr. Ahmed who is here, sharing video. Mr. Ahmed, how are you, Mr. Jalal Ahmed? If you can hear us, you can say a few words. Mr. Yusuf Ali, how are you?
Yes,
Sir, it is
good day. After a long time, sorry. Yes, today I'm happy to participate. Thank you.
That's great. So welcome everyone. We will be starting the next few minutes. Today we have a very outstanding person who will be speaking. He's indeed a great inspiration. So we will be starting in the next few minutes. Meanwhile, if you're here, you would like to say something, feel free. I can see our friend Mr. Rata is here. Miss Anne is here. Hello, Mr. Rata, how are you? It is good again to see you.
Yeah, good day. Looking forward to it today.
Yes. How is the weather today in Canada?
We're actually going to be about 0 degrees Celsius today, but we've gone through about a week and a half of minus 25. So,
wow, minus 25. That's really cold. Okay, so it's already 4 o'clock here in Durban, South Africa. It's time to start our webinar. More people are still joining, so let us wait a few seconds and then we can start. I see there are 6 people in the waiting room. Dima, please admit them in. Our guest today, Dr. Samir Asaf, is really an inspiration, and all of us in this room today will be really empowered after this session. They say, the opportunity of a lifetime should be seized within the lifetime of the opportunity. So thank you for seizing this opportunity today to be here amongst us. And we are about to start. Without any further delay, as people are still joining, we are going to start. Let me invite Dr. Haider. Dr. Haider, are you here? I see you joined. You are joined already. Dr. Haider.
Hi, good morning.
Good morning to you, Dr. Haider. Good to see you again.
Glad to see you all here. Welcome. It's a sunny, shiny morning, but a little bit cloud in the sky because of the influence from Canada and North America. Probably the air is a little bit darkish here. I'm not in Canada, I'm in the Caribbean at the moment, and as you can see my background, it's like that background. Welcome everyone to the summit. As usual, appreciate your participation and joining. Doing fine. I'd request all our participants to keep them muted for the moment until they speak. I hope I'm audible because my internet was having a little bit of a problem this morning.
We can hear you, Dr. Haider. We can hear you clearly.
Thank you very much. I can see all our friends joining from all around the world as usual, and we are very thankful to you for your participation, and I'm sure you get the benefit as well from this webinar that we are holding on from the COVID time. And definitely we have connected so many businesses all across the world, and many of them got benefits, and many of them got the results that we believe in. Today we have an outstanding speaker, one of the most brilliant person that I know of, having his education from all the institutes, most of the famous institutes in the world, like the Boston College, he went to London School of Economics, Oxford, Harvard, why not? He did his PhD from Switzerland, and he has 31 years of experience, Dr. Asaf, working in different positions in global organizations like AT&T. He was a director in AT&T. He was a senior consultant in IFC, World Bank Group. And he's a teacher he's teaching in the Stanford University. And he's also involved in a couple of the organizations that are doing business, and he's also into his own business. He's the senior partner of Reason Financials, one of the major investment banker in the USA, and we are part of that Reason Financials. And also he's the managing director of Del Morgan and Company, another financing company in the US. Dr. Asaf is here, so he will be talking more on the financing aspect and in general how the world economy, macroeconomy, and all this. He has tremendous amount of knowledge. So without wasting more time, I'd be willing to invite Dr. Samir Asaf to present himself and also make his presentation for our participants. And the good news is that once his presentation will be over, you will be having the opportunity to raise questions to him. So please feel free and keep your pencil ready to note down your questions if you have any. And any questions you have, you can also raise on the chat box. We will be very happy to answer, and we'll be very happy to connect Dr. Asaf, and we work together. So we are partners, and we will be very happy to get you a favorable solutions at any point of time that you want. So with this, I would like to welcome Dr. Samir Asaf here in this room. Dr. Asaf.
Well, thank you, Dr. Haider Uzzaman and the Business Summit. It's a great pleasure to be with all of you. So today what I was planning was to give you a quick presentation on global mergers and acquisitions market, as well as the sort of the financial institutions and the different products that are out there to raise capital. So give you a flavor of what's kind of going on, what are the trends globally. And then we can do a Q&A, maybe 5 to 10 minutes at the end. I want to be able to have some interaction with you all, and then maybe we can close out the session with some positive outcomes. So shall I share the screen here and start the presentation, Haider?
Yes, please. You are the co-host. You can go ahead.
Okay. So I'm just sharing the screen, and I'm opening up the presentation here. And I just want to make sure that everybody can see. Okay, if you all should be able to see my screen right
Yes.
now. It says M&A and capital raise. Okay, if anybody can't see the screen, you can probably it's all good.
You can see.
All right,
you can see. All good.
Right. Okay, so what I want to do is just kind of quickly go through this and then take the Q&A at the end if I can. All right, so two basic topics here: capital raise and M&A, and these are very big topics. So we have just captured a sliver of these two areas in this presentation. So first part, we talk about kind of this capital raise and financing space, and then the second part of the presentation we get into kind of M&A trends. So first thing I want to highlight is that the financial services sector obviously has the whole investment banking space and the commercial banking space. We will be really focusing on investment banking for the most part in this presentation. And the first thing that I want to highlight is that there are a lot of changes, like, as you know, the disruptive forces that are affecting the financial services sector, the investment banking industry. We talk about some of these. that from the financial service provider side of things, there's a lot of changes. The technology is changing, value chains are getting unbundled, buyers are becoming more sophisticated, demand curves are shifting. There is crowdfunding going on in a small scale. There's fintechs going on, lots of changes. And also, there are new industry realities like products and services getting commoditized. There is obviously pricing pressure on us, the investment bankers, and we have to kind of go for customization at scale. So kind of mass customization, if I can put it that way. And so what investment banks are doing now, or planning to do in general, is that they're realizing that instead of having one big monolithic structure, front office, middle office, back office, it's probably more efficient to go for kind of a bifurcation of the services provided. So think about front office, flow, front office are client capturers, and then middle and back office are flow players. So kind of these two segments. Increasingly, investment banks are becoming more and more specialized. So think of, on the right hand side, we see client captures. This is the front office. Okay, so you'll increasingly find investment banks or broker dealers in the US in particular that are, some of them are specializing in sort of sales, capital light. They are on the client capturing side. Okay, client facing. And then the middle office and back office related work, trading and sort of reporting, asset servicing, transaction processing, market making, prime services, and so on. And also like firm commitments, balance sheet based financing, all that can be supported with the middle and back office functions. So that's what we're calling flow players. So core competences are being divided here. Another trend that we're seeing is, if we get into some of the data, what's going on in sort of, we look at VC, we look at PE, we look at debt, all of them in this presentation. So VC funding, we are seeing overall, you can see from 2014 to 2022, that's about an 8-year trend here, and we can see pretty flattish, a bit upward trending, and you can see deal values are going up, right? So deal values are going up, and you can see how many transactions sort of are taking place sort of on a kind of quarterly basis. You can see thousands of transactions happening, and you can see this kind of angel and seed versus early VC versus late VC. There's kind of an uptick in the last sort of since 2022. Really, you can see this kind of a upward trend here, and then obviously 2022, 2021, the COVID impact is very much there. Kind of the same story on the PE deal activity side. Again, we are taking a kind of a long view here. Estimated total deal value, you can see quite a big, $5.4 trillion here, and then there is kind of a differentiation between sort of deal counts are also going up. 5,500 deals. This is based on PitchBook and just based on US data. So here, the key takeaway I want you to see is this kind of upward tick that's happening in the last few years, kind of unmistakable, right? You can see increasingly this space from 2009 to 2018. So deal activities are increasing, private equity space as well. A new product that you might have heard of or might not have is sort of special purpose acquisition vehicles. This is very interesting. It's taking off in the US. Just wanted to throw it out there. Basically, SPACs are publicly listed shell companies, and then they acquire operating companies and then become operational. And so that's a quick way of getting public listed and raising capital. Doing very well in the US and has tremendous potential in terms of capital raise. Now, moving over to the debt side, here I want to show you both high yield and investment grade spaces, and you can see since 2019 to sort of the latter part of 2022, you can see investment grade, sort of debt issuance, investment grade securities really dominate the space. I mean, that's one of the important things to realize. And then high yield is kind of a small part of it if you look at 2022 in general. And in a way, you could say it's flight to quality. You could say, you could look at the sort of the interest rate yields for U.S. Treasury, 10-year U.S. Treasury. Again, we know that the interest rate environment is going up all over the world, right? Interest rates ain't what they used to be, and so. Okay. Right. So please mute yourselves so that you don't have any, unless you have a question. Okay. So and then so the high yield index, again, you see high yield bonds are delivering a much higher return, albeit at higher risk. Now, if we look at kind of a geographical view, again, trying to take a look at private markets, right? This is private markets, not public. And you can see over $1 trillion raised here, quite a big growth. But what I want you to notice is that North America still is the dominant space for private market fundraising, right? And you can see rest of the world 29% growth. North America is growing, grew at least 2021, grew at a faster clip. Asia kind of was usually Asia leads, but in this case we see that Asia was growing less fast. So, but in terms of a more general view, again, I want you to see this across asset classes, the volumes of financing is going up. Just a little bit about sort of multilateral development banks. You have the ICs of the world where I used to work. Again, the Asia Pacific region, if you look at that, one of the instruments that's taken off quite fast is sort of sukuk issuance. These are Islamic bonds that are compliant with the Islamic Sharia financing structures. So this is on the debt side, and you can see that particular product, sukuk issuance, has grown tremendously. Again, Islamic finance, if you look at the growth, if you look at about total Islamic finance assets back in 2026 was about $2.2 trillion. So it is an asset class that is unmistakably growing very, very fast. And so in most portfolios, you will see that this sort of, especially alternative asset class portfolios. And one of the things, those of you who are not quite familiar with Islamic finance, one of the key things is that it doesn't support interest rate ushery, in other words. So the investment product essentially is more like a preferred share rather than a straight bond, although it behaves like a bond in all respects. So if we look at capital provisions to total loans, we can see that according to McKinsey, sort of global banking pool, again, you can see that this is 2024, and provisions obviously went up recently during the COVID period because of the defaults that took place. Loan loss provisions, yep, they went up, and then we are actually expecting the loan loss provisions to continue to go up because the bankers really are trying to keep the risks low, keep the NPLs low. If we look at by industry in the first half of 2022, if you're going by geography, we see that what are the countries that are going to be able to recover more quickly. I mean, there is wide expectation of a recessionary trend in 2023 with a soft landing in 2024 according to IMF forecasts. So we are definitely not out of the woods, guys, right? You see, the expectation was that China, Canada, Singapore, Hong Kong, South Korea, Saudi Arabia, these countries would essentially be early exiters from the, sort of the COVID situation and recovery, right? And then this year, US, Australia, France, greater part of Europe, but then the war obviously is the big challenge here. And then late exiters, we're talking about India, Mexico, South Africa, and so on. So the global banking industry is going through, global corporates are going through a lot of challenges, as you can see. So emerging markets, if you focus on emerging markets, we can see that NPLs are relatively stable, right? But they are pretty high, in sort of the CIS region, the SSA region, and so these are, who is to say how they're going to move forward, but Sub-Saharan Africa, that's a challenging space, as you know. But we hope that the NPLs are going to come under greater control, and defaults will gonna go down a little more. We also know that the Basel III capital adequacy requirements, those are getting tighter with all kinds of liquidity requirements on the financial institutions. Now, a little bit on the fintech, we got to highlight, because they are really disrupting the industry, right? So the commercial banks, the investment banks, we are actually trying to figure out how to digitally transform without sort of being averse to fintechs. So there are all these services that are being that are coming into the space, payments, products, digital first banks, alternative lending products, personal finance tools, wealth management products, think about robo advisors, insurance products, also capital market products, talked about the online capital raise market, small and medium businesses, as well as real estate. They're disrupting all of these spaces, fintechs. So drilling a little bit deeper on the sort of distributed finance landscape, you can see there are a lot of players, right? These are all fintechs, and they are offering their services in all these different layers, in terms of tools, in terms of interfaces, in terms of crypto, although that took a bit of a hit, but it's down, but not out. Trust me, it's going to be back. And so the DeFi protocols, and so there's kind of happening in the DeFi landscape. So as investment banks, we really need to, and we are in the process of, embracing the technologies there. Okay, so that's the quick summary of kind of capital raise space and some of the data around that. What I want to highlight or get into now is the M&A space. So what are the trends in M&A right now? And so there was, I'm part of the Association of M&A Advisors in the US, and we've done a recent survey, very recent, hot off the press, and that's the data some of the data I want to show you today. So first, taking it from the top, global M&A trends. Again, you can see 2020, was a dip, but 2021, again, things started picking up. There's a lot happening. That's the key takeaway for us. A lot of companies that put things on hold, they are actually getting back on track and beginning the initiatives on the M&A side. So, in terms of in terms of M&A buyers, you can see that the the corporate development teams, they're the ones that have done most of the activity. And over 2021 and 22 was from the corporate side took a smaller share of the deals. And then you can see the private equity platform guys, platform investments over here, and then add-on investments over here. Again, about half the size of corporates. Then you have individual sponsors, family offices, and so on are small, right? This is really a small space, but really the corporates and the Ps are dominant in the M&A space, as you would expect. Now, this is the latest data on 21 first half versus 22. Second half, and 22 first half versus second half. And so essentially for the year, these are the smallest size transactions on the left, then you have mid-sized transactions, you have largest size transactions here. And this is actually showing us what percentage in terms of volume, how many deals actually took place. And as you can see, mid-market is the space where a lot of the bulk of the activity is happening, up to the 30 million mark. And then as you go above the 500 million mark, the number of deals obviously fall off significantly. EBITDA multiples, you can see that as the deals get larger, the EBITDA multiples that are fetched are obviously higher, and you can see that trend going. And this is pretty consistent over the last 4 years of data. So this is one of the very simple but yet insightful takeaway that I want to make sure all of us here appreciate and understand, is that as the deal size increases, the EBITDA multiples the companies are able to generate in M&A transactions increases. And the reason for that is obviously the larger the company, the more structured the management, the more improved their corporate governance and compliance and all those things. And they're just more reliable, safer, lower risk. And so on a risk-adjusted return basis, you would certainly be willing to pay a larger EBITDA. So that's what we are seeing. The data support that. Then by deal size, again, we are seeing a little bit of a dip actually, in some cases, because this, there is 2020 and 2021, here we are seeing a little bit of a dip, right, in this 20 to 30 million to 50 million range. And we don't know the answer why that is, but that's what the data shows. And but we still see this sort of upward tick as the size gets larger there. Now by industry, closed deals volume by industry, which are the industries that have been most active in the M&A space versus, so you can see business services, B2B, healthcare has been big, manufacturing has been big, construction materials, IT services, data, cybersecurity big, consumer products, and then you taper down here, financial services not so big, transportation, warehousing, energy, and so on. And then at the bottom of the rack, you have sort of retail, hospitality, IT products, rental, leasing, biotech, and so on. So one of the reasons, in particular, the biotech volumes were low is that there was a significant amount of activity prior to 2022 in some of these sectors that almost got saturated. Okay, so let's take a look at some of the data here, and we'll show you first half of 2022 here, and then we'll show some successive data. But across industries, we can see that, for example, in first half of 22, we see healthcare, business services, manufacturing, and so on. Average LOI price, letter of intent, average sales price, again for $20 to $50 million range here. And these companies have had a revenue, again, between $11 to $30 million. The revenue multiples have been around 1. So pretty tight valuation 2022. Lots of, as you know, a lot of tech companies have taken a big hit on their valuations. Average EBITDA multiples have been in the 2 to 4 range, which is interesting. Other than we see consumer products and retail, bricks and mortar retail fetching significantly higher EBITDA multiples. If you look at the second half of 2022, more recent data, we in terms of revenue multiples, we're still in the sort of the 1 range, right? And obviously depends on the industry, 1 to 2 range. Nothing really crazy there, but average EBITDA, again, you can see the second half. You see the average EBITDA multiples are again in the mid, single to mid single digits, right? Low single digits to mid single digits. Average EBITDA margins in these industries, pretty healthy, I would say, 20%, 20 to 30% in many cases. Some of the industries obviously fetch significantly higher. Healthcare here fetching a 7.4 multiple. In terms of growth, this was a bit surprising, at least for me, because across all industries combined, you can see an average annual growth rate of 13%, and that's a pretty strong growth rate. And one of the key takeaways that one of the conjectures rather I could draw here, I suppose, is that companies that are looking for transactions are in general better performing, because we are probably not looking at distressed transactions here. So better performers, better revenue growth, better margins. So the average is average of the transactions that have taken place, and so it might be biased upwards. And then really fresh data, first quarter of 2023. So here we are seeing, again, on average, the construction and business services have, and then as well as manufacturing, they've been at the top of the list as far as sort of these transactions go. And again, revenue multiples are around 1 to 1.5. EBITDA margins mid-single digits to mid-20s, and then EBITDA multiples 5 to 7 to 8. Now I'm going to show you something interesting data points as well. Now earnouts have been significantly more prevalent in the second half of 2022, as you can see, much more frequently post-close salaries and compensation related earnout. So the owners stay on, right, with the business and deliver according to the KPI projections, and then earn their earnouts in a couple of years, and then that actually fills the gap between the price that the seller is asking for and the price that the buyer is willing to pay. So earnouts have been very, very, very interesting. Now, if you want to close your M&A deal, obviously you need an LOI. What are the top factors that are helping these companies close these deals? And we've highlighted some of those based on our survey. And so revenue growth, obviously TTM, trailing 12-month revenue growth is key. Revenue consistency is very important. We call it EBITDA stability. So EBITDA margins, very, very important. Intellectual property, patent rights, often undervalued. Companies are often undervalued because they don't properly value themselves. A lot of companies in these equity transactions, those of you trying to raise capital, one of the most important things for you to value your company, right? And so you don't want to value your company based on assets, right? So that's the liquidation valuation. So earnings-based valuations are good, multiples-based valuations are good, real options-based valuations are good. Upside growth potential is key for these LOIs. Of course, branding, don't forget the branding. Your company's brand, product brand is key. Investors want to work with companies that care about their brands and have sort of good customer experience management, good customer loyalty, and things like that. Obviously, low customer concentration also. You don't want to have a portfolio where 1 or 2 customers, the 80-20 rule, that would make your revenue expectations more volatile. Again, distribution distribution, factor distribution for LOIs, we can see, EBITDA margin, revenue consistency, upside growth potential, last 12 months revenue growth, and revenue from repeat business. These are the most important elements if you want to have a transaction. These are the things that investors value the most. Okay, so upside growth potential, revenue consistency, EBITDA margin, revenue growth in the last 12 months, and then revenue from repeat business. Again, as I mentioned, customer loyalty is key. Now, this one is very interesting, a very interesting finding that the LOI is the letter of intent. That's the offer from the potential buyer for the company, right? So assume a M&A transaction, and we'll show you small deals and large deals both. So small deals, what this 100% line shows us is, LOI was X and the transaction happened at X, okay? Now, all these dots under the 100% means that the transactions actually got closed at a price that is lower than the original offer, okay? So that's interesting. And so as you can see, the larger the deal up to 50 million, you can see there are quite a lot of deals that actually were able to be negotiated at higher than LOI. Interesting, right? And then let's take a look at large deals, obviously fewer, but what is interesting is the distribution is more, as you can see, skewed towards the premium rather than the discount, right? You can see that. So above 200 million, what's happening is the buyers are actually paying about 20% more compared to what they originally offered, in some cases 30% more. So, and on what would allow you to raise more or create more value, obviously it's the valuation, and it's how you place it, how you pitch it, what's the story, what are those elements. Remember, we looked at these 5 elements: upside growth potential, revenue consistency, EBITDA margin, revenue growth, and revenue from repeat business. So if the negotiation can generate, as you can see here, 20 to 40% more value on the entire size of the deal. Okay, now monthly trends on M&A close. End of year, there is typically a peak. December, they want to close it out before the next year. So in terms of timing, keep that in mind. Other than that, it's pretty standard. Nothing special there. Average M&A deal duration. How long does it take to close these things? Well, the blue is private equity add-on, private equity platform, corporate strategics, right? So about 4 to 5 months it will take for an investment bank that's helping you to kind of close it, okay, and to get the LOI for you and get the offers actually, and then it's going to take another 3 to 4 months average, guys. This is average. So another 3 to 4 months to close, and that includes legal due diligence, and that's basically it, and then negotiations, right? So 7 months for private equity platform investments, 4 and 3, 7.5 months. Remember, that's average. The range would be, I would say, it can go down to about 5 and go up to maybe 8 or 9. A lot of it depends on how quickly the legal departments close this. So again, time to close. This is just deal size, and you can see, which is interesting, that it's not that smaller deals close faster and larger deals take longer. What is interesting here is that they take about the same time, about 5 to 10 months. Some deals can take up to 20 months. Very unusual, but I'd say 10 months you can see here. But if I could draw a line, I would draw a line right here, right? You can see this kind of peak is something like here. So that is, in fact, this 6 to 7 month time frame. So it does take time, guys. It does take time to close these things. EBITDA multiples by deal size, we said again, is going up over as the deals get larger. But just take a look at this number. Active deals 2023, 9.7 times multiple raised by companies want to raise 100 million. It's not really that big an amount, but about 10 times the multiple. So if your company's EBITDA is $1 million, you can expect, depending on how much you're trying to raise, of course, if you're in this range, depending on what's the valuation of your company, if it's around 50 to 100 million, you can expect to get about 7 to 10% multiple on that. So 1 million, 7 million to 10 million would be the valuation. So 7 to 10 million is a valuation. In fact, it won't be 10 times. So you got to do the valuation first. Get the EBITDA. Take a look at the multiple that you can derive. Now, why do people sell? Well, a lot of middle market deals, and I'm not talking about very large deals, but middle market deals, is retirement. The owner wants to retire. That's the majority of the deals that are happening. The motivation is that the owner is getting old. And personal financial factors, those are key. And then M&A, market, market trends. A lot of people look at the economic outlook, M&A outlook, and then make those decisions whether they want to get into a transaction. Tax law changes, investment opportunities, inflation, legal and regulatory, all these factors actually come into play. So the point here is that sellers sell not because of one reason. There are multiple factors that come into play. And factors impacting current deals, labor shortages, interest rate changes, supply chain issues, cost of goods changes, the whole supply chain disruption that has happened, and labor costs. All these factors also come into play when a buyer is trying to buy, a seller is trying to sell. It's not just a financial decision. So what we basically as advisors, what we recommend on the sell side, really, it's also kind of all over the place. In some cases, we say, just wait and see, and that is what typically is the last thing advisors say is wait and see, because first mover advantage opportunities, good opportunities should be capitalized on if you can. Sometimes it's about restructuring of the company, and then more often than that, it's about preparing for the sale and watch the markets and valuations. So you've got to prepare your company for sale. It's not, you can't just decide and go and sell it, right? So you got to put the right conditions in place internally so that you can maximize the valuation. Actively pursued by buyers. Again, most of the buyers are actively actually pursuing deals. Guys, there are more than $6.5 trillion of dry powder available. And so we are, as investment bankers, trying to make sure that we add value to the investors as well as to the sellers. And now, estimated change. This is interesting because the question here is, what do you expect the EBITDA to change by, by mid of 2023? And you can see that about a third are saying that it's going to be about the same as last year. How many feel that EBITDA will increase significantly? Very, very little. Okay, so 2023 is not a year where you can expect EBITDAs to go up significantly. But here, take a look. 18% and 34%, and all these are actually assuming that your EBITDA will significantly go down, if anything. Okay, so that's kind of a negative view. So if you wanna get a deal done, probably get a deal done quicker than later. It all depends on your EBITDA projections. Deal prices, again, the same thing. Deal prices actually likely to go down a little bit rather than going up compared to what it is now. About half of the respondents felt that the deal sizes in 2023 will be by mid 2023 will be about the same. But I just wanted to highlight that this section, the global economy is going to be probably 2025 and beyond before it starts picking up. Okay, so I'm going to pause here and open it up for Q&A. Either way, I just want to open up for Q&A. So feel free to ask questions if you have any.
Yes, thank you, Dr. Samir. If anyone has any question, please feel free to ask Dr. Samir. In fact, I was just telling Dr. Haider, this is so interesting. So if anyone has any question, please feel free to ask. You can also ask on the chat. Okay, Mr. Thompson raised his hand. Please feel free, Mr. Thompson. You can ask your question.
Right. Good day, Dr. Samir, and to all attendants. I'm representing our small company, and we are interested in finding what would be angel type investment opportunities for developing in the Caribbean. Well, our home base is in Grenada, and we have what we think is a golden ticket where we are looking to build towns, or in our scale, we call it cities. But we want to build modern towns using green initiatives, eco-friendly building technologies, etc. But as you would know, these are very capital intensive investments with long-term repayment plans. And it has been proving to be quite difficult in finding these sources or these revenue streams through our regular commercial banks. We do have an exchange system, but we haven't considered going on that exchange just yet. And we basically got invited to this event really to see what are options available for us in the Caribbean. I'm not sure for the rest in the event.
Thanks, Garth, for the question. Angel investing is the initial stage where new entrepreneurs with great ideas and they raise capital, and obviously this is a space where you should expect to be a bit challenged, because the companies at these stages obviously don't have the history, they don't have the balance sheets, they don't have the track record and so on. So it's a bit difficult to raise capital quickly. But you can, Garth, you definitely can raise capital. There are thousands of seed stage investors. Now angel is even prior to VC, so angel space is more friends and family, and you may have a few personal investors, high net worth individuals who can give you some financing. There are the challenge, of course, everything is a give and take. Challenge is that angel investors will take a huge share of the equity at a very, very low price, right? So they might give you $100,000 and say, give me 30% of the company. They want to be fair, but they're taking a huge risk, and these 80% of startups fail. We know that, and that's the scary part. So what you should do is kind of be in a bootstrap situation, be very cost conscious, and try to raise some capital from friends and family. And sometimes the governments help out these small businesses. There are green initiatives, obviously supported by lots of financial institutions. I know I was working at IFC at one time. We fully support green initiatives and sort of ESG and social, anything that helps anything has a social CSR perspective. So if you want to build these cities, if you can come up with the right business plan, then you can reach out sometimes to VCs as well. But it's challenging. I'm not gonna give you any undue hope, but don't think it's not possible. You're in a space that's attractive. I think it's about telling the story. It's about creating some level of trust, and if you can do that with investors, they'll listen to you.
You are muted, Mr. Thompson.
Oh, sorry. Yes, I just didn't want to have any interferences. But yes, I fully acknowledge, and we are seeing the challenges ongoing. one of the good parts, because it's real estate and Grenada as a small Caribbean island, we have been seeing a boom in land prices and the values going up. So for example, one of our projects involved a 200-acre lot. Currently, the buying price is about 20 million US, and the estimated resale price, once you put infrastructure into it, could easily be over 80 million, going up to 100 million. But the wait time is the issue. A city doesn't start overnight, so we have to have people willing to be on board for the next 10, 15-year projections. And well, as you said, angels, so far, friends and family, we haven't got that big of a community to be able to raise that first 20 million to secure the 200-acre lot of land. So that's why we still have to, well, as you said, it all comes down to the story and convincing another investor to be willing to partner and risk with us going forward. So fully acknowledge your advice, and we'll keep on. We're not in it to lose. We're in it to win.
Yeah.
Okay. Thank you, Mr. Thompson. Thank you, Dr. Samir, for your precious advice and guide. Anyone else has any question? Please feel free to unmute yourself and you may ask. I think we do have one more question.
I have.
Chat. Okay, please.
I see a few questions on the chat though. Do you see?
Yes, please go ahead, Mr. Arno. Please go ahead.
Okay.
Hello?
Yes, Mr. Arno, we can hear you.
Yes, I actually had placed, good morning, I had placed my question into the chat, and I can repeat it for those that are not seeing. It says, good morning, Dr. Samir. Please advise how your, thank you. Please advise how your firm makes money in typical transaction. In other words, what's cost to the client? So if you're probably doing a business plan and you're getting ready to present to yourselves, you want to be able to put into that plan or into the process an idea of what that cost is, as well as whether your firm has an interest in investing in projects in the built environment in the range of 10 to 15 million US in Guyana.
Great. Thanks for your question. How our firm makes money? Basically, we are regulated by the SEC and FINRA in the US as investment banks, and so we cannot, it's very specific what we can and cannot charge, and it has to be fair and reasonable according to the US securities laws. So basically at two stages, we charge our clients. First is, we don't charge any engagement fee, but the document preparation and the due diligence part, we would charge a due diligence fee. That is not a profit center. It's basically our time and materials cost for document preparation, due diligence investigation, which also has, we take on a liability there as well. So due diligence fee can range from $0 to $300,000 for a deal, right? So it depends on the deal, it depends on the complexity and how much time and resources will be required. Sometimes we would, we would take, say, $50,000 only, and say we would do it because the client has already a lot of documentation ready. They have the information. They have, it's just less work needed, and so on. But the profit center for investment banks are at the end, right? It's the success fee. We call it a success fee. It's usually, for equity raise, is usually between 5 to 7.5% of the value of the transaction. And for debt raise, it's typically between 3 to 5% of the value of the transaction, right? And if these are if these are securities that are exempt from the SEC, SEC registration requirements, then the Financial Industry Regulatory Authority in the US is not going to actually review or approve the charges on the success fee. But if these are not exempt transactions, then they would review and they would have to approve. So the key point here is that the 3 to 5% for debt and the 5 to 7.5% for equity raise are basically required to be fair and reasonable. So now 10 to 15 million, Region Financial helps clients raise capital. Yep, we can do 10 million and above. We obviously prefer to do larger sizes than smaller sizes. Clients, it all depends on the client's project, the value of the company, and we actually do the deal structuring, so that helps us figure out how much can the client raise. I mean, a lot of times client will come and say, how much can I raise, right? Well, then we see that there's no valuation yet. They just have a balance sheet. They've never done a valuation of the company. So that is an exercise that needs to be done. And then the discussion about whether it's going to be debt or equity, and then the discussion around what's the best structure. So did I answer your question fully, or?
Partially, and as a result, I've got, if it's okay for me to have a couple of follow-up as a result of what you said.
Sure.
Sure. I recognize the discussion about the percentages and the debt equity, etc. structure, but that is speaking from the American perspective. This presentation I am looking at from the Guyanese perspective. Therefore, I will ask the questions: are you set up presently to work within the laws and regulations in Guyana? And reference to the valuation of the projects, this is at the low end, but again, is for me to understand how you are positioned to work in Guyana. If you could address that, whether that's current or proposed or what. Thank you.
Yeah, absolutely. We work with companies coming from all over the world, right? And the United States securities laws apply to us and everything we do, but the clients we work with on the ground, obviously that country's law, securities law, and all other laws are fully applicable to every transaction. We cannot do any deal in a country that is sanctioned. We cannot sanctioned by the U.S. Department of the Treasury or any individual. So as long as Guyana, I don't think Guyana is a sanctioned country. As last time I checked, Guyana is perfectly fine. So yeah, we should be able to. The process would be exactly the same. We would take a look at the merit of the project. We would then strike a deal with the client. This much you pay due diligence. This is how much we'll charge you. We'll send them an engagement agreement. If the client is okay with it, if we sign, we get to work. It takes about 4 to 6 weeks to do the documentation. Then we do investor reach out. We are connected to over 30,000 investors, PE firms, hedge funds, family offices, and debt, about 5,000 debt providers, and we'll structure the deal for the client, for the Guyanese client, right? And under Guyanese laws. Now, if there is something that in the Guyanese law, if there's something that is conflicting with the US laws, then we'll take a look at it. We have our legal counsel. We'll take a look at it. Typically, typically these are, investors want to invest in good projects, and they want to work with good people. That's my kind of main takeaway. If your client in Guyana, they're good people. By good people, I mean, honest and forthright, and doing all the work, delivering the result as a good company, as good fiduciaries for the shareholders. If they have a reasonably good structure, they're law-abiding, should be perfectly fine. I don't see an issue.
Excellent. Thank you, sir.
Welcome.
Thank you, Mr. Ano. Thank you, Dr. Samir. We also have one question on the chat from Mr. Kanani. If you are here, you may ask on the platform, Mr. Kanani. Okay, I can read the question. His question is, so I have a question about minimum amount and maximum amount that you can fund and on which interest. That's question number 1. And question number 2 is, we have a project that needs 300 million USD. It is a cement factory. Can you fund it, and on which interest rate? So I am assuming the second question overlaps the first question. Dr. Samir?
Sure. Yeah, sure. So I'll take the first question first, minimum and maximum. So minimum is, I would say, $10 million. Less than that becomes almost too small. But yeah, so that's kind of minimum. Max is, we really don't have a max, in the sense that if you want to raise $2 billion or $3 billion on a big, big project, we'll get you 4 investors who will invest $500 million each and take up the position. Yeah. If you want to raise $10 billion, we'll probably get 10 investors, $1 billion each. But it's unlikely that you would have one investor putting in 10 billion or one investor putting in 2 billion and be the single investor. They typically want to manage the risk by co-investing. They like to have co-investors. So upside is essentially unlimited. So minimum is that. Interest rate. So if it is debt raise, then only the question of interest rate comes in, right? So if it's a debt raise, the interest rate would depend on your credit rating. Okay, if you're highly credit rated and you're going for a, say, 5-year term loan for $300 million, and you have a credit rating from Standard & Poor's or Moody's, you'd probably be able to get it at between 4.5% to 6.5%. And why the range is because, is it fixed rate? Is it floating rate? How much collateral you're giving? What's the loan to value ratio? There are a lot of factors that will go in before the final interest rate offer comes in. But when we raise debt capital for clients, we would get multiple term sheet, multiple creditors, and we would do a limited auction process to get you the minimum interest rate possible from the creditors, and we are connected to 5,000 of them globally. So I can confidently say that you would, based on market conditions, you would get an extremely competitive rate. But now, if you are not a A-rated or investment grade rated company, then it's not investment grade, right? In that case, you're not operating at a 4.5% to 5.5% range. You're probably operating at a 6.5% to 8.5% range, right? But we are experts at financial structured finance, so we can structure in all kinds of ways, unlimited number of ways, essentially, to minimize your cost of capital on the debt side. On the equity side, if it is a preferred share issuance, then it's similar to debt, and you can think of a cumulative, participating, convertible, structured, all varieties of preferred share issuance. And again, it would be slightly higher typically than debt raised. If it's a common equity issuance, then there is no question of interest rate. There is no question of guaranteed or committed dividends, right? So you essentially get the money for free until your board decides to pay out a dividend, right? So there, the returns that the common shareholders expect would be even higher than the returns your debt holders expect, right? So you're probably looking at, depending on the risk level of the project, you're probably looking at a IRR of something between 22 to 25% that would satisfy the investors.
Great. I think that's is really sums up the answer he was looking for. Mr. Kanani, I think it would be good if you could give us some more information about your project. Maybe you can send us a deck so we can have a look. We will collaborate with Dr. Samir Asaf and have a look at this project. Surely interesting. So please forward us your deck on our email address. Lima, could you please put our email address on the chat? So again, thank you, Dr. Samir. Thank you so much for your kindness for always giving us a clear answer. We have one more question. I would say if you have a question, it would be good if you could ask, but it's on the chat. Mr. Arman, if you're here, you are welcome to ask your question. Okay, I think some of our friends are shy to ask you, Dr. Samir, but it's fine. I will read their question. I am looking for investment for our current plastic manufacturing industry in Bangladesh. Currently, our turnover is nearly $500,000 USD per month. Please advise me how I can get investment in easier way.
What was the revenue? You said $500,000 per month?
Yes, $500,000 USD.
So that's $6 million revenue per month. That's not bad, actually. That's per year. $6 million per year. That's not bad, actually, right? So plastic manufacturing is a very attractive space. How you can raise the capital? There's a long answer and there's a short answer. Let me give you the short answer. The short answer is you give the Business Summit a call and they'll connect you to me and Dr. Haider, and we will have a call and we will look at all the options you have, equity, debt, how long it will take, what would be the cost. And I mean, if you have a profitable company, guys, even if you don't have a profitable company, capital can be raised. Even if you have negative EBITDA, we can raise capital for you. The question is, you would have to be willing to do the work, in terms of coming up with the plan, coming up with financial projections. If you want to get shareholders in, they are foreign shareholders, foreign direct investment into Bangladesh. You would need to be ready to have them on your board. You have to think about your company's strategy, right? It's not just the money, guys. It's the strategy. It's the whole, capital utilization plan. What's your goal? So as your advisors, we will help you find the cheapest and fastest way of raising the capital. So, that's the short answer. For you just to get in touch with us and we will discuss all the options. Debt raise is difficult for Bangladesh right now. As I understand it, that the central bank is only approving debt raise on a case-by-case basis. So equity raise is better for you. And so if you are interested in that, we certainly would be interested to talk to you.
Thank you, Dr. Samir. Thank you again so much. Mr. Arman, please feel free to send us your project on our email and we will be more than happy to help you. If anyone else has any question, does anyone else have any question, please feel free to ask online or on the chat. I do see one question on the chat, but it's not directed to Dr. Samir. Please, Mr. Navs Otto, we would be happy to help you. Please send us your deck. We will be happy to help you. He's looking for someone who would be interested for a joint venture with a used vehicle importer in Guyana. So it's not, Dr. Samir, would you like to answer that one? They are looking for a joint venture for a used vehicle importer in Guyana.
Yeah, I mean, JV in the sense that we do get strategic investors to come in and invest, and in a JV type of situation, we can potentially attract strategic investors in any industry.
Sure. Okay. Anyone else has any question? Please feel free to ask.
Well, I think there will be, sorry for the interruption. I think there will be questions from our participants. As we can see, the number of participants were more than 60, 70 today. And there are plenty of questions. Some of them are contacting me as well. Between one of our clients and from Malaysia, Mr. Kana Ketamba, he's here, Mr. Kana Kethambi. He's here and he wanted to have a word for us. He's known to us and our client. and he's known to Dr. Samir Asaf as well. So if you are here, Mr. Khanna, if you are free to have a word, please.
Hey, hi, Haider. Hi, Dr. Haider. Hi, Samir. Hi, everyone.
Hi.
Hey,
Welcome.
Anna, how are you?
Good. Now, I've been Dr. Haider actually introduced me to Dr. Samir Asaf, and I like to say that Dr. Samir Asaf has been very, it's been a good guide in helping us in Ainka. Ainka is a healthcare technology company based out of Malaysia, and we are looking to raise quite significant amount of money. And I think I'd like to say thank you, Dr. Samir Asaf, for guiding us so far. We are really looking forward to seeing that we will be able to move to the next steps and see how we can do the fundraise that we are looking for. And it's very interesting. I heard the whole session just now. It's useful to understand the EBITDA perception and the revenue multiples and what the M&A transactions are and what are the challenges that you've been facing in fundraising, especially within the investment banks and all those new and more creative ways of raising funds that are coming up. It's an interesting environment. I mean, and given that Ainka is looking to do continuous fundraise, I'd like to be seeing how the more of such summits like this, if you can organize, it'll be helpful for people like us to understand the trends. I mean, yes, Dr. Samir and I have been discussing quite a bit on the way forward, but understanding the industry perspective gives us some options on to see how, especially when I heard that Sukuk is easier and it's becoming more popular now, and that can be a good option of raising funds for very large projects and ones with a longer gestation period. So all in all, thank you, Dr. Haider, for bringing me to Dr. Samir, and thank you, Dr. Samir, for guiding us so far. So I look forward to seeing how we can work together, and I hope you'll be able to help more of those people who are around in this call. I see a lot of people from everywhere, from Caribbean to Malaysia. Interesting.
Yeah,
Drawing
the
a
whole
crowd.
world is here. Thank you,
Yeah.
Khanna. Thank you for your words. You can see we bring people from all these 6 continents around on the screen. So that's our efforts that we are very happy with. That's our passion, in fact. So to help people all around that we have been doing for since the COVID time. So that's what we are doing. Thank you so much for your kind words, and we look forward to close your project as soon as possible.
Thank
you.
You,
Thank you, my friend. Well, I think there are tremendous amount of questions coming up. So I would say our admin to take note of this project of questions, and we can probably connect them shortly. Otherwise, it will probably take a longer time because some of them have already joined more than 1.5 hours already. So do you, Dr. Asaf, do you want to answer some more of these questions that we are having, or do you want to take it on a one-to-one, a case-to-case basis later on?
I'm good for 10 more minutes, Dr. Haider. So
okay, great. So Mr. Avi, can you take some of this question from the chat room and then get it answered by Dr. Asaf, some of them, please?
Sure, Doctor, no problem. Let me first answer this one. Mr. Arman is asking me where to communicate further. Lima, could you please send our email again on the chat so Mr. Arman can have our email? Okay, the next question is, I see. Good evening, Dr. Samir. Is it possible to fund a new startup in India? I have a ready project. It's on regional airline with small aircrafts.
Yes, it is. It is certainly possible. The documentation for new projects needs to be very clear about what you're trying to do, because you don't have a history. We would have to create a very robust and practical set of projections in terms of revenue, in terms of profit you can expect to get. And the other thing is, if it's a new company, investors would certainly want the assurance that you will be able to do it, right? So if you think about an airline, there are minimum scales that airlines need to reach. I would say probably one aircraft, probably not enough in terms of economies of scale. You'd probably need permission from the regulatory authorities to fly those on certain routes. So those are things that you'd have to put together in the story, that getting the relevant regulatory approvals, doing a good analysis of the routes and the business plan effectively for your region airline company. And so demand, supply, who are the competitors, what are the prices, and so once you do that, you plug that all into the financials, and what we could do for you is to help you develop the documentation and the valuation of your company based on present value, future cash flows, and other techniques. One other thing, if it's a new company, you'd have to put in basically about 15 to 20% of the value of the project, and minimum is 10%. I mean, investors, if you want to raise 100 million, you need to put in about 10 to 15 million. That might be by way of assets or cash or land or any kind of asset. What would not work is for you to say, I need to raise 100 million. I want an investor to put in 100 million. I'm simply going to run it. Investors don't like that. They want to see that you've put in some of it. So at least 10 to 15%.
Great. I think that does answer the question. So Mr. Sen Gupta, please feel free to send us more information. I think we need much more information so Dr. Samir and our team can help you. Okay, I see there's another one question. Lots of people from Guyana today. Okay, let me just come to the question. What is the appetite for agribusiness investment, especially in emerging countries like Guyana?
Well, there is appetite for agribusiness. If you see the aftermath of the European war and Russia, that severely did the agriculture, right? And a lot of focus then went on to sort of self-sufficiency and alternative sources of securing food supplies, right? So if you think about exporting from Guyana, certainly that's very attractive.
Great, thank you, Dr. Samir. I am just going through the last question, which we missed before. It's someone asking on behalf of Mr. Thompson, the first person who presented his project about building towns. And Mr. Stanley is asking, would venture capital be a feasible option for Mr. Thompson?
Yeah, I mean, it depends on what's the stage of his project, right? So if VCs would come in after angels, right? So like VCs can come in at a pre-revenue stage, but they would probably not want to come in if you got nothing, right? If you just got an idea in a PowerPoint presentation, you got nothing else, VCs would not be interested. They want to see a little bit more than that. They want to see a couple of people, they want to see a website, they want to see a very solid market research done on your product. What problem does your product solve? Where is the demand? even if it's pre-revenue, it's still okay. And if you have a very little amount of revenue or any source of revenue, that's where VCs seriously start taking a look at you, right? So there's Series A, Series B, Series C, and so on. But I think you need to kind of figure out where you would fit. I don't have enough information to be able to say whether that company, that real estate building cities, that company would be able to attract VCs immediately. For example, they would want to come and visit you in your office, in your country. Investors would come in. Where would you, do you have an office? Do you have some employees? Do you have some kind of operation which you have funded yourself with family and friends? If you have that, if you can show a team, if you can make a presentation that shows the plan and say, this is exactly how much we want to raise, this is exactly what we're going to do with it, with the money, this is how much equity we'll give you, and we are going to hire an audit firm, and maybe we're going to hire a good audit firm to audit us, and you will get quarterly reports on our progress. We will have quarterly board meetings or monthly board meetings. You will attend those. You'll get 30% of the company if you invest $5 million, etc., etc. Then the story starts coming together, and then the investor says, okay, so if I did give you $5 million, what's in it for me? So again, we go back to you and say, well, what does the investor get back? And so what's the ROI? We need to do all that calculations, and we figure out that the investor will be able to get this kind of a return. Then the investor has to decide, right? You gotta see, based on the risk. Obviously, it's a high risk situation. They would want a very high return. But the story, your story with the real estate is always a kind of a lower risk situation in general, because whatever they invest in is backed up by the value of your land. It's never going to be zero. You raise 20 million, you buy this piece of land, even if it doesn't grow even 1% in value, you still have the $20 million land, and that land is going to grow at about 5 to 6% to 10% a year in terms of value. Just a land appreciation, even if you do nothing. So that's why I say that it's kind of the risk on the downside is sort of limited downside risk. So you might be able to attract VCs. That's my guess.
Thank you, Dr. Samir. I think we should take one last question. It's been more than 10 minutes. But again, I would encourage all those asking questions to send us more details, because the questions are very general, and it is good Dr. Samir is helping us, but it would be good to have your project with us in hand, and I'm sure we'll be able to give you a more detailed answer and a better guide. So thank you so much. I will ask this last question and we will end after this. What about waste management technologies plants in African countries? Dr. Samir?
That's waste management is always close, near and dear to my heart, because it cleans up the cities, it cleans up the environment. It's just wonderful always to work with projects that clean up the environment, EHS, green, and all that stuff. So absolutely, waste management, and you can look at a lot of best practices in waste management technologies and plants and services offered by the European countries who are extremely advanced in this area. And if you pick up a best practice from there and generally deploy it in African countries, you got a winner.
Yes, thank you again, Dr. Samir. I think we have reached the end of our webinar for today. Dr. Samir, I personally was very, very empowered with your presentation. So thank you again for that and for answering everyone's question. Dr. Haider,
most welcome. Great pleasure.
Thank you so much. Dr. Haider, if you're here, we would like to end our webinar. Yes, you're here. Thank you.
Thank you. Thank you very much. I want to thank all our participants today, especially the speaker, Dr. Asaf. Thank you so much for the excellent presentation today. You have really given us an insight of the financial situation, financial market situation globally. I appreciate that. Thank you so much for your time, and we look forward to work with you closely. And as we can see, our friends from India, from the Caribbeans, from Canada, and from Malaysia and other places, they're showing interest even in Africa. So we are, we'll be in touch with them, and anyone need any further information, please feel free to shoot up an email to us. We will immediately connect you and try to get you the solutions that you need. And I look forward to see you soon in our next webinar on the 1st of April. And before that, I want to see some of our friends are making real-time progress and real-time success, like Kana is very hopeful, and then his project is offering, and he's so happy right now. So we look forward to see you on the 1st of April and talk again. And we want to hear from you what your progress that you have achieved. I thank you very much. Thank you all, and have a nice weekend.
Thank you.
Thank you, everyone. Bye-bye.
Bye.